your income statement, or even in general, your business financials? Is it kind of like the equivalent of opening up your junk room, looking around only to be completely overwhelmed, close the door, and never look at them again? I get it. In fact, I'm in the middle of cleaning out my junk room right now. So, but I don't want it to be that way as far as you're looking at your business financials, particularly your income statement, or when I say income statement, profit and loss statement, exact same thing, just two different terms. So why is this important? It's important because you need to know kind of where you are in your business, and you also need to know how to read it, because if you're not looking at the right things on your income statement, you could be bypassing some serious red flags that you need to address inside your business. So what is an income statement? It is a snapshot of time of your income and your expenses inside your business. It's not going to be the equivalent of the money that's in your bank account. So let's say you made $200,000 on your income statement. You're not necessarily going to have $200,000 sitting in your bank account, but you still need to learn how to read it because it's still very important in terms of your business. Okay, so what I'm going to do is I'm going to screen share a sample income statement or profit and loss statement and kind of show you how to really read it and really use it to your advantage so you can make better decisions in your business, so you know what to look for in that statement and keep making great money in your business. All right, let's get into it. Okie dokie. So we are looking at a profit and loss statement from a sample company in QuickBooks. This is what it would look like if you go in and pull a profit and loss / income statement. So same thing, profit and loss, income statement, same exact report, just slightly different as far as the name calling on it. So let's just take an overall look at this. What I have done is, let me refresh this because I want you guys to see this. I always want to start with what's called a collapsed version, and it's not as nitty gritty. And I think it just helps simplify things. And then once you kind of get that bigger picture, then I suggest go in and do an expanded version. So as I'm resetting this, it's going to take a while because of course I'm doing a video and it's going to take forever. I kind of want you to see how I do this, and you could also ask your bookkeeper or accountant how to do this. Well, it does look like it is a collapsed version. Let me just do an expand version. So you might get something. There we go. Okay. So if you go in and download into QuickBooks or look at something or ask your accountant or bookkeeper for an income statement, they may most likely, depending on the settings, give you something that, to be honest, looks a little overwhelming. You've got kind of these headers and these subheaders, and it's a little too much to kind of look at. And that's one thing I want to discuss with an income statement is you need to have enough information, but not too much. I've seen income statements where it has sales, office expenses, miscellaneous expenses, and that's it. And then I've seen income statements where it has every little nitty gritty expense. That's too much. Neither one of those is going to give you the right information. For example, payroll is one of those. I'll see a lot of different payroll expenses. You'll have your payroll taxes. You'll have your cost of doing payroll. You'll have the actual wages. You'll have the benefits. You'll have this and that. And for some businesses, that is necessary. But I think if you're just trying to get an idea of what's my payroll, just have a payroll line and have all of those items in one line. I'm not saying that's always a great idea. It depends on your business. But if you want to just get your hands around this, do that. So what I would say is ask for a collapsed version, and you can go up here and go to collapse. And that will kind of summarize, but not summarize too much, if that makes sense. So we are pulling this in accrual basis. An accrual basis is going to be if you invoice out, if you do sales on an invoice type system, it is going to be those sales on the date of those, not necessarily the date you get that cash in. If we were doing it in cash basis, it would only be on the day the money came into your bank account. Ideally, you want to go with accrual, especially if you're invoicing out and you're paying on bills. Accrual is going to help you look forward and forecast. Okay, so we got the income statement up. I've got it in a collapsed version and I've got it on accrual, and I'm just looking at a month. So your top line is always going to be your income or your sales or your revenue, all of that. And you typically want to see positives. If you do see negatives, that can also be if you've got, sometimes I've seen discounts put up in the income section. Sometimes I see discounts put down in the other expenses section. That doesn't matter, but ideally all your income, everything on here needs to be a positive number unless it's like a discount. So you've got your income and the cost of goods or a cost of sales. So that is what is the bare minimum cost to get the job done, to get paid. So that's not including your indirect costs. That would be your rent, your admin payroll, your insurance, those kind of items. Your cost of goods is going to be, what does it take to just deliver the product, the bare minimum product or service to your customers? So that is going to be in your cost of goods. And so we've got income here, and then right after income, these are going to start being your expenses. So you'll notice you don't necessarily see a minus, 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 minus for expenses. That's just happening automatically in the math down here at the bottom. And then you've got your general expenses. So your advertising, your automobiles, insurance, legal, professional fees, office expenses, utilities, all of that. So these are your regular items. And then other is typically going to be, it could also be other income or other expenses. Other income could be if you got a rebate on something, or if you did a employee tax credit refund and you got some kind of refund in, that's going to go into other income, because that's not necessarily income for your sales. So you don't want to factor in that as sales, because you really didn't do it as sales, but it is income into your company. And then other expenses, same thing. Other expenses could be something like depreciation, something that is an expense to your business, but it's not necessarily an expense for doing business. Okay, so basically how to read this is just top to bottom. You're going to have your income, you're going to have your expenses. This is going to be your gross profit right here. So that is your income minus the bare minimum cost of doing business. And then all of these expenses should be your indirect costs, such as your rent, your insurance, those items. And then at the bottom, this is going to be your net operating income. And then if you have any other income or expenses, this is going to be kind of your net. This is your net income is your bottom line right here. When people say bottom line, this is your bottom line. So a month is good. If you look at 1 month, that's okay. But I think the true magic in looking at a income statement is when you start to compare. So I always like to compare at least 3 months, even sometimes 6 months. That's going to tell you a lot. That's going to tell you the trends in your business. That's going to tell you if things are skewed. That's going to tell you if things are consistent. Let's go ahead and do 5 months. So let's do January, and then we're going to go month, and then we're going to hit run. There we go. So this is where the story takes place. And this one actually looks like a really fun one. So you can see where things just ramped up. So that's a great trend line right there. Your income just keeps going like this. So that's awesome. And then cost of goods is kind of going along with that. I would think you would have cost of goods here. So if I saw a bunch of zeros here, and obviously you made income here, I would maybe question a few items. Maybe they didn't get categorized correctly down here and should have gotten put in here. Again, this is a sample company, so I'm not going to say this is 100% accurate P&L because it's completely made up. So that would be a question. And this would be a question too, is did we really only have to spend $405 to make $8,000? Maybe, but that would be something to question. And then these are all your other expenses. And I always like to compare these line items to see, are they being consistent? Let's say a rent. Rent should be something that's pretty darn consistent. It's not going to change, at least for usually 6 months to 12 months. So maybe rent didn't kick in till May. Maybe that was a landlord's agreement. But I would wonder, where did these other months come from if we were in business in, say, February? You know, most of these line items should be consistent. You're always going to have some peaks and valleys, but I think being able to explain what those are is what's going to make a difference and help you really feel really confident in your numbers. So, for example, legal and professional looks like it has some swings. That's okay, as long as you kind of have an idea. Think back, oh yeah, I had to pay an attorney bill in January, and then we had this in March. We didn't have anything in April, and then we had 2 attorney bills in May. If you can the breakdown, it'll help you be able to pinpoint, okay, that's what that was for. And then you can always drill down on these. When you're looking at it in QuickBooks, you can just click on it and it will actually drill down on exactly what those expenses were for. Okay, well, it looks like that's not going to load. But if you click on these, anywhere you see where it turns blue and then it underlines, that's where you can click in. So what it'll do is it'll open up a new page and you will see the actual detail under that category. Let's go down at the bottom line. So this is looking really good. So this is a great looking P&L. I mean, there's going to be startup costs. So that's, there were no sales in January. It looks like there were a few startup costs. And then we start ramping up had a little bit of dip in March, ramped back up again, and then bam, it looks like May, you're really off to the races. So I think a one-shot month is good. It's a nice to have. Every time you run a P&L, I always prefer at least 3 months because it gives you those trend lines. It helps you create the story. It helps you ask questions. It helps you compare. It helps you show the direction of your business and which direction it's going in. It will highlight those things that look skewed or off. So I think the true magic happens is always running a monthly, at least 3 months P&L. A 1 month is great, but having that comparison with 2 months behind you is so much more helpful. All right, I hope this helps. Let me know if you guys got any more questions.